So, are you thinking of moving abroad? Or maybe you're already living that expat life. It's an incredible adventure for sure, but it also opens up a whole new world of financial admin. Today we're going to draw out an essential map for you to help you navigate your UK tax obligations even when you're no longer living here. All right, let's get right into it. To make this all feel a bit more real, we're going to follow a character. Let's call him Alex. Now, Alex has just packed up his entire life in London and he's off to sunny Lisbon. He's obviously excited, but there's this one nagging question in the back of his mind. What on earth happens to his UK tax life now that he's not actually in the country?
You see, the very first thing Alex needs to figure out is his official status. And, well, it's not as simple as just hopping on a plane. The UK tax system has a very specific and kind of complex set of rules to figure out if you're a resident or a non-resident for tax purposes.
And this right here is the key to everything, the statutory residence test, or the SRT. Now, what's interesting is this test couldn't care less about your nationality or what passport you hold. Nope, it's a very technical test, all based on how many days you spend in the UK and the connections, or ties as they call them, that you still have, like a home or a close family here. If you don't meet its requirements for a whole tax year, that's what officially makes Alex a UK non-resident. Okay, so Alex is all settled in Lisbon, loving life. But, like a lot of people who move away, he's decided to keep his flat back in London and rent it out for some extra income. This simple decision instantly makes him a UK landlord, and that comes with a whole set of UK tax duties, even though he's sipping coffee thousands of miles away.
Right, so the UK has a special system just for this. It's called the non-resident landlord scheme. The default position is that Alex's letting agent, or even his tenant, believe it or not, has to withhold 20% basic rate tax from the rent and send it straight to HMRC. Now, Alex can apply to get his rent in full without that deduction by filling out a form called an NRL1. But, and this is the really critical part, whether tax is taken off or not, he still has to file a UK self-assessment tax return every single year to declare that income. No getting around that.
Let's fast forward a couple of years. Alex has decided he loves Lisbon so much he wants to buy a place of his own there. To get the money together, he's going to sell his London flat. And this move brings up a totally different kind of UK tax, capital gains tax.
Now, this is where a really important rule for non-residents kicks in. The UK is going to tax Alex's profit, sure, but not on the growth in value over the entire time he owned it. The gain is what they call rebased. Because it's a residential property, his taxable gain is only calculated on the increase in value since the 6th of April 2015. Basically, any profit he made before that date gets ignored for this tax calculation. Pretty neat, right?
And here is a deadline you absolutely cannot ignore. It is super strict. From the day the property sale goes through, Alex has just 60 days. That's it, to report the sale to HMRC and pay any capital gains tax he owes. This is a totally separate, urgent thing, and if you miss it, you're looking at penalties. Honestly, it's a classic trap that catches so many people out.
Okay, so we've talked about property, which is definitely on HMRC's radar. But what about Alex's other stuff in the UK? His savings in a UK bank account or his shares in UK companies? Well, on this front, there's actually some surprisingly good news for non-residents.
This is all because of a special rule for something called disregarded income. So while things like rent and UK job income are always taxed, the UK takes a much more hands-off approach to investment income for non-residents. Things like UK bank interest and dividends are usually paid with no tax taken off at the source. And under these rules, a non-resident's UK tax bill on this income is limited to whatever tax was already deducted, which, in these cases, is, well, zero.
So what does this actually mean for Alex? It means that the interest he earns from his UK savings account and the dividends from his portfolio of UK shares are for all intents and purposes tax-free in the UK as long as he's non-resident. Now, he might have to pay tax on them over in Portugal, of course, but his UK tax headache on that income is just gone. It's a massive perk.
But what if Alex's move isn't forever? What if, after a few years of pasties the natter, he decides to move back to the UK? This is where a major, and I mean major, anti-avoidance rule comes into play. It's like a tax boomerang that can come flying back and hit you if you're not prepared.
This whole thing is known as the temporary non-residence rule. It kicks in if you were a UK resident for at least 4 out of the 7 tax years before you left, and your time away lasts for 5 years or less. As you can see from this timeline, if Alex comes back within that 5-year window, he falls right into this trap.
So what's the big deal? Well, let's imagine that while he was in Lisbon, Alex sold a big portfolio of shares that he owned back when he lived in London. At the time, as a non-resident, he paid no UK tax on that profit. But because he came back within 5 years, that gain is suddenly treated as if he made it in the year he returns to the UK, and it becomes taxable. Ouch.
It can also apply to certain types of income. Now, we're not talking about the dividends from his normal publicly traded shares. Those are usually fine. This rule is really aimed at dividends from what are called closed companies. Just think of small family businesses controlled by a handful of people. If Alex had a business like that and took out big dividends while he was temporarily non-resident, that money could also get taxed in the year he returns.
And finally, pensions. If Alex took some hefty withdrawals from his UK pension while he was away, we're talking more than £100,000 in total during his time abroad, that whole amount could get taxed when he becomes a UK resident again. The rules are basically designed to stop people from just popping out of the UK for a couple of years to pull out profits and cash completely tax-free.
Phew. Okay, so we followed Alex all the way from his departure to his life abroad and even a possible return trip. Let's try and pull all of this together into a clear, simple roadmap for anyone who's thinking about a similar journey.
All right, here's your essential checklist. First things first, be absolutely certain of your residency status using that statutory residence test. If you've got UK property, you have to get on top of the NRJL scheme and that 60-day CGT reporting rule. They are not optional. Make sure you understand and use the disregarded income perk for your UK investments. It's a real gift. And crucially, always be aware of that 5-year tax boomerang if there's any chance your move isn't permanent. And the last point, which is maybe the most important, everyone's situation is different, so getting professional advice is always a smart move.
Moving abroad. It's so much more than just a change of scenery, isn't it? It's a huge financial event. The rules can be navigated, for sure, but they really do demand a bit of planning. So the final question is, if you're on this journey, have you taken a moment to actually write your own tax chapter? Because planning ahead is what turns a potential nightmare into a smooth adventure.